Okay, good afternoon, everyone. This is day 30 of the section, and we'll continue our discussion from where we stopped. Today is Sunday, the 16th of May, 2021. And this afternoon, we'll be discussing from where we stopped yesterday with respect to consolidated statement of profit or loss and other comprehensive income. And likewise, we'll also be looking at the comprehensive, that's the consolidated statement of changes in equity. Okay, today we'll be looking at other aspects in addition to what we have looked at in part one of this discussion. In part one of the discussion, we have extensive discussion on introduction to basic consolidation principles with respect to profit or loss. We also venture into looking at how do we attribute profit between the parent and the non-controlling interest. We went further towards making necessary elimination with respect to dividend that is paid within the group. And we also went towards issue where we have loan within the group that created interest income in one party's book and interest expense in other party's book. We now went further to look at critical adjustments that is paramount in group accounts. We deal with intercompany transactions relating to sales of goods. And we look at it from two perspectives, where the parent initiated the transaction, thereby selling to the subsidiary. And secondly, we look at it when the subsidiary sells to the parent. And we'll try to look at the implication regarding the up and downstream transaction with respect to how the impact of that adjustment affects parent and affect NCI as the case may be. We'll further wrap it up with discussion regarding sale or transfer of assets, an item of PP, especially those that also have impact with respect to depreciation. We look at that and we're able to make justifications to that. And we'll wrap it up looking at adjustment that is required upon disposal if it happened in the current year, where it could trigger adjustment for realized profits. And we also look at adjustment regarding excess depreciation that may be attributed to transfer of assets within a group above the carrying amount. How this depreciation affects the distribution or appropriation of profit between the parent and the non-controlling interest. Today, we are going to start by looking at situation that warrant acquisition of a subsidiary during the year. At what point do we start to consolidate? That is what we want to look at. And what are the implications of acquisition during the year, especially the implication it has on group adjustment with respect to intercompany transactions. These are what we are going to look at today, and we are going to also look at aspects by extending our consolidation beyond profit or loss to other comprehensive income. Okay, we look at how it affects other comprehensive income, and we look at all various adjustments relating to impairment of goodwill. How is it treated within the group, considering the fact that it could be full goodwill or partial goodwill, and all other necessary adjustments. And I believe today we should be able to do justification towards wrapping it on as a move on. Thank you very much as a move on. And today, as I've said earlier, we'll start our discussion with respect to acquisition during the year. Now, I believe we are aware upon where we carry out our understanding of principle with respect to consolidated statement of financial position, where we treated acquisition during the year. Now, remember from the basic principle of group account is that the day of acquisition is the day of inclusion. And what that presupposes is that that is the first day in which you start to combine the result and the balances of a subsidiary with that of the parent. The question then is, when you acquire a subsidiary during the year, from the angle of the income statement, from the angle of the statement of financial performance, at what point do you start to consolidate? Let's assume a subsidiary was acquired 3 months into the year, and it means it's going to have operation of 9 months that will be incorporated along with the parent in the group account, which then implies that the first 3 months will never be consolidated because the first 3 months are not integral parts of the entire process in which the parent has control over the subsidiary. The control of the parent over the subsidiary commences from the date of acquisition, and that is the point at which the parent can start to combine the transactions and balances attributable to operations of the subsidiary as at that date. And therefore, that is what we want to take into consideration now. At what point do we start to consolidate? And to do that, I want somebody to read this question for us so that we can more or less use that as a bait towards creating an understanding of the basic principle as required with respect to IFRS 10 and IFRS 3. Over to you guys. Anyone can read.
Okay, let me read it. Seventh principle. Okay, acquisition during the year. Okay, I should write from illustration 14, or I should read from
start from the beginning.
Okay. In some instances, acquisition during the year. In some instances, it has been observed that subsidiaries are sometimes. Oh, I should read the question itself.
No. I think I can only. Sorry, continue from where you stopped.
Okay. So, in some instances, it has been observed that subsidiaries are sometimes acquired during the year. The implication of such acquisition is that part of the profit for the year would be pre-acquisition profit or loss, while another part is considered post-acquisition profit or loss. Furthermore, it is necessary and essential to separate the subsidiaries' items of profit or loss into the pre-acquisition items and post-acquisition items, as only the post-acquisition items are required to be consolidated with the financial results of the parent as at the first reporting date. In summary, only the post-acquisition element of the subsidiary's profit for the year is consolidated. Illustration 14. Arsenal acquired 80% interest in the equity of Chelsea as at 1st April 2016. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended December 31st, 2016. Okay. Okay, I think we can just go through this, go to the additional information. This one, what do you think? So I should just mention these ones.
No. Continue with additional information.
Okay. Additional information. Given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity.
Okay, thank you very much. Thank you for that question. Now, what is unique about the question is what we have here. Okay, what is unique about the question is that we acquire the subsidiary on what date? The subsidiary was acquired.
Okay, acquired on 1st of, yeah.
And you can see that this is your reporting date. Okay, if you look at these two dates, how many days apart or how many months apart? The months apart is the whole of April, May, June, July, August, September, October, November, December. That is 9 months, which is not up to a year. The question then is, we must be able to pick these items here and break them into various components of what portion of it was in January, what portion was in February, what portion was in March, what portion was in May, up to the portion in what? December. I remember the portion from April to December is what will be consolidated, while the portion between January and March will be ignored. Why? Because between January, February, and March, Arsenal does not have control of Chelsea. The control of Chelsea was obtained on 1st of April 2016, which then means that is the sales revenue, cost of sales, distribution costs, admin costs, income tax related to period beginning 1st of April 2016 up to December 31st, 2016, that have to be consolidated with Arsenal. Therefore, what do? Is for us to have knowledge of the business. Does the business have a monthly performance reporting so that we can be able to attribute 390 into the first 3 months, which will be exempted from consolidation, and the next 9 months, which will be consolidated, all through other lines. But in practice, it might not be evident in such a manner. Therefore, what we now rely on is to rely on the nature of the business. Is this a business such that revenue is expected to have accrued evenly, or revenue at some periods are higher than other periods? Now, when we look at the information provided to us here, we are not given information, but the basic assumption we are going to have is to say this revenue accrues what? Evenly, which means I'll come here to say our basic assumption is that revenue and profits accrue evenly. What does that mean? It means if you have generated 390, each month will have contributed equal amount to make 390. If you check your calculator, like mine, which means revenue for each month of the year will be 390 divided by 12, which means each 390 each month generate 32.5 million. That's what it means. And which then means that we only consolidate 32.5 million for the 9 months, and we do not consolidate 32.5 million for 3 months. How do we do that? We now have to come here and say that though we have this I'll shift it 1. Why am I shifting it? Remember, parent is 12 months. The result of this subsidiary is also 12 months. But we don't need 12 months of the subsidiary. What we need of the subsidiary is 9 months, which means the subsidiary what we require in the subsidiary is 9 months. And this 9 months is to cover, the 9 months is to cover for period. This is January to December. This is January to December. But what we needed is not January to December, but what? April to December. And April to December is 9 months, 1st of April. Therefore, what we'll do is that this, we don't need it. We need to cancel it out. Let me find something to stroke it out, if I could. Okay, I can use, let me borrow this arrow I make use of yesterday. Now I can use this arrow to say, I don't need this. Which means this is not going to be consolidated. What will be consolidated is 9 months. Now, since we said profit accrues evenly, therefore we'll find 9 months of it. 9 months of this is to say 9 divided by 12 multiplied by whatever this is. Therefore, I pick 9 months of this each and I consolidate. Now, what will I consolidate? What I'll consolidate is no longer, it is 12 months of period and 9 months of the subsidiary. And this is what I'll consolidate because my consolidation should start from the date of acquisition and not necessarily from the beginning of the year. Okay, does that make sense to you? This is the principle we are trying to test here. That is, 9 months is a period in which you have involvement in the affairs or transaction of the subsidiary from the perspective of the profit or loss. Therefore, it's only that 9 months you have to consolidate. And to consolidate that is to find 9 months out of 12 months on the premise that we said the basic assumption says profits accrues what? Evenly. And that is that. Ability to do that now speaks to the fact that what we are now going to apportion is not 25 million, it's now 18.75, which means I'll come back here and say, what am I apportioning? Is this amount, which is 18,750. This 18,750 is what I'll now recognize. At the end of the day, 68,750 has been shared in this manner. I remember what we did yesterday. If you want to see it too glaring, you can create the total column, which is what you have here. I can copy this total column if you need such, which is not necessary. I can bring it down to what I wanted to do. I can copy it here. Okay. At the end of the day, I have my results at the group level, which means consolidation should start from the date of acquisition. Okay, you don't consolidate transactions or results prior to acquisition from the perspective of the profit or loss and other comprehensive income. Any question on this? Any question on this?
I think there are some instances for materiality purpose that parties may agree that the sales discussion started probably before the end of the year, probably concluded midway into the year. We can agree on this liaison agreement. if media will not be very feasible and not be so material. I think that is also possible. Or
No, I want to get your statements.
What I'm saying
I didn't get you clearly.
Okay, what I'm saying is that for the number one, I said if is immaterial, irrespective of time, if it's not too, if it's immaterial for it to be consolidated mid-year, let's say it happened maybe end of January, and that 1 month difference is not much. I think starting from beginning of the year may actually be allowed. I'm just asking if it could be allowed. Two, especially by both parties.
No. It's not about materiality.
Yes, that's what. Okay, so two, I said if there's an understanding between the parties, the acquirer and the acquiree.
What kind of understanding?
Okay, the discussion about the acquisition probably started, let's say, August, November, or before the year end, and it probably ended around maybe March or April. And then they understand that, then there's an understanding that, okay, since this thing ended here, and because of the complication of this mid-year, we don't know some transactions, and let's just start from the beginning of the year so that it will be straightforward. Based on that understanding, I think first of January.
I don't think what is straightforward, what is not straightforward.
Okay.
Regardless of your understanding, the substance of the transaction will prevail over your understanding, especially if it is material in nature, that your consolidation of the result will start from the date of acquisition. That is the date you obtain control. The only thing is that your understanding should not give you control when you have not yet ready to take that control. But once you take control, you can't define into the future when you want to start to consolidate. No, you consolidate from the date you gain control, okay? Which may not be the date you have executed the transaction of acquisition, because certain conditions might still need to be fulfilled in order to obtain that control. And that's only when you can defer obtaining control to a future date. But the question is once control is obtained, regardless of the fact, you start to consolidate from that point in time. Okay. Thank you. Now, let us now see how intercompany transaction plays a role in acquisition during the year. Now, what I'm trying to say is this. I'll put this question to you. Imagine that before this acquisition on 1st of April, the parent, the supposed parent, had made sales of goods to the supposed subsidiary in February 2016. And as at that time, there was no acquisition. And in 1st of April, there was an acquisition. Now, with such a transaction requires elimination from the group perspective in our group accounts. Sales you made to that entity was in February, but you later acquired that entity in April. The question is, will that trigger adjustment for one, elimination of sales revenue and adjustment for unrealized profit through the adjustment will trigger under the cost of sales adjustment? Would those adjustments be required or necessary in that regard? Whether yes or no, you have to justify from your own perspective before I could break the ice. Who will contribute?
Good afternoon once again.
Good afternoon.
In my own perspective, I believe that any transactions that occur between the supposed parent and supposed subsidiary prior to the acquisition should not be eliminated, because my understanding is that the transactions is expected to be dealt with as if acquisition did not take place at all. Then when there is acquisition, for example, when the acquisition takes place from 1st of April, I believe whatever transpire during that period is what I expect to qualify as cancellation or elimination. Thank you. That is my own opinion.
Okay, what basis supports your opinion?
It's just my opinion, no basis.
Okay. Any other person?
Okay, I want a transaction between both parties before the date of control. I think that transaction will be regarded as out of will not be, there will be no adjustment for that transaction, because it is a transaction that is outside the group, because the group had not existed at that time. But I think there will be little problem if those goods, as at the date of control, remained unsold. If they are unsold, either at the date of control or the date of I think the date of control, if they remain unsold, then adjustment need to be made for those transactions. But if they have been sold before control took place, I think there will be no need for any adjustment. That is the way I see it.
Okay. Thank you very much. Yeah, I think at some point, two of you agree, at another point you departed. Now, the position is very clear. The transaction that took place between you and a company before you had a relationship is not an intercompany transaction. It's not a related party transaction. Therefore, that will not trigger elimination from the angle of the transaction itself, which is recorded through profit or loss. But if that transaction creates a payable or a receivable even before the acquisition, and that amount remain payable and receivable after acquisition, it is that balance that constitutes intercompany balance, not intercompany transaction, but intercompany balance, because that balance was still existing between both parties as at the time the relationship takes place. Therefore, such a balance would be eliminated, but it will not retrospectively go back and adjust for the transactions that create those balances. The reason why I'm emphasizing this is that from the balance sheet, regardless of whether the receivable and payable were existing before or after, once they are in existence as at the time a relationship exists, such is an intercompany balance, which have to be eliminated. But the transaction that created them, if those transactions were consummated before the relationship, such transactions will never be eliminated, except if they create a balance, which I've explained earlier. But if they don't create a balance, that transaction will not be eliminated in the statement of profit or loss and other comprehensive income. Which then means that at every point in time, you have to ask yourself, transactions that affect profit or loss and other comprehensive income, once those transactions were done before that relationship or parent subsidiary, such transactions will be ignored as if they never occurred, because they were occurred before the marriage. But if those transactions occur after the marriage, the transaction will be adjusted for in full like any other transaction without being prorated. The only thing that comes with proration is the entire transaction of the subsidiary that took place from the date of acquisition, which is less than 1 year, to the reporting date. Now let's look at this question to put that understanding. Can somebody read it up?
Okay.
Illustration
Go ahead
15.
now.
Okay, illustration 15. Arsenal acquired 8% interest in the equity of Chelsea as at 1st April 2016. The board of Arsenal strictly wants to comply with the requirement of FRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31st, 2016. Okay, there is a table of the statement of income statement for the year 2016. Then additional information states it was obtained that on the 15th of March 2016, Arsenal already sold goods to Chelsea for 60 million when it actually cost Arsenal 40 million. As at the year end, including the inventory of Chelsea PLC is 40% of the inventory sold by Arsenal as at 15th March 2016. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million.
Okay, thank you for that question. Now, let's look at the information here. When was the acquisition? 1st of April, 2016. When was this transaction? The transaction was on the 15th of March, 2016. Now, this transaction, does it qualify as intercompany transaction? Does it qualify as intercompany transaction?
No.
Since it's a capital no, this transaction will be ignored. Will be what? Ignored as if it does not what? Occur. And in that case, our solution will remain what? The same. Which means there's nothing to be eliminated. There's nothing to be what? Eliminated. The same way we have it. Does that make sense to us?
Yes.
Yes.
Okay. Shegun, welcome after a long holiday. I believe you have been following up with the videos.
Thank you very much, sir.
Okay. Now, let us now change the narrative to another question. Another question is that we change the date from 15th of March. We change it to another date, which is after the date of acquisition. And let us see what our position will have been. That should be question 16. Okay, let me get the question out for you guys. Now, the question now, which is question 16. Okay, I want somebody to read this question and tell me the difference in it.
Okay, let me read it. Illustration 16. Question has disappeared. Okay. Illustration 16. Arsenal acquired 80% interest in the equity of Chelsea as at 1st April 2016. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31st, 2016. Income statements details are below. Additional information. It was observed that on the 19th of May 2016, Arsenal already sold goods to Chelsea for 50 million, when it actually cost Arsenal 40 million. As at the year end, included in the inventory of Chelsea PLC is 40% of the inventory sold by Arsenal PLC as at 19th of May 2016. Required, prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million. And the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million.
Okay, now look at when this happened. It occurred, the transaction occurred on the 19th of May 2016, but acquisition took place on 1st of what? April. This was some days after the acquisition. Does this constitute intercompany balance? Transaction. Does it constitute intercompany transaction?
Yes.
Yes. And if it constitutes intercompany transaction, what do we need to do? What should we do? What should we do?
I think for me, what we need to do is by the time we assume that the sales and transaction occurring fully for the year, then we take the nine months of the year. That 9-month portion, we have to remove this intercompany, this particular transaction.
Okay, which means this transaction will be eliminated in full.
Yes.
In the group account.
Yes.
Abi?
Yes.
On consolidation. Okay, let's try and do that. Now let's try and do that. And take note, bear in mind that this May 19th is my birthday, and therefore by Wednesday I'll be fortified by God's grace on 19th of May. Therefore, I'm expecting my gifts.
Your birthday gift. Well, what the coincidence? Same with my other sister.
That's very great.
Your dad also?
But I said that's the same with my other sister.
That's very great.
Okay, your other sister. Tell her to send me a present too.
No Allah, no Allah.
Okay. Now,
happy birthday in advance.
Yeah, thank you. Now we have already done the 9 months here. Nothing is changing in this 9 months, Abi. The only thing is for us to do the adjustments. What are the adjustments we did earlier on intercompany transaction relating to sale of goods? Now, who sold to who again? Is it upstream or downstream transaction? Who sold to who? Arsenal sold.
This is upstream.
No? Arsenal sold.
Okay, downstream, yes, Arsenal sold. Okay.
That's downstream.
Yes.
Therefore, Let me look for the template for downstream. Okay, this is a template for downstream. Let me copy it so that I won't need to type again. Now, what was the transaction? Arsenal sold goods for 50 million. Okay, which means our sales revenue to be eliminated is 50 million. Now, but the cost of what was sold by Arsenal was 40 million. And that is our cost of sales here, which means our profit on intercompany sales is 10 million. But that does not necessarily translate to unrealized profits. What is unrealized? Unrealized profit is either the percentage of unsold goods multiplied by the profit on intercompany sales, or where you are given the markup and you are given the cost of unsold goods, or where you are given the margin and you are given the value of unsold goods. In this case, from this information we have here, we have obtained the profits on intercompany sales, and we are given the percentage that was unsold. 40% of these goods were included in inventory. Any good item included in inventory are considered unsold, because if they are sold, it can't be in your stock. In that case, 40% of this 10 million is unrealized, which is what we have gotten here, 40%. Now, this 40%, which is 4 million, is what we deduct from our intercompany sales revenue to obtain our cost of sales adjustments. Our cost of sales adjustment, as I've shown you yesterday, is not necessarily going to be the same with your actual cost of sales from the perspective of the seller. No. The cost of sales adjustment is what we allow us invariably, after knocking out the double counting of revenue and double counting of costs, that will allow us to eliminate 4 million, which is the unrealized profit. And that is why here we come here to eliminate. We come here to eliminate the 50 million, which is intercompany revenue, and we also eliminate cost of sales adjustments. And at the end of the day, what do we see? We produced the 4 million. And this 4 million, as you can see it here, is what we are trying to eliminate in order to get a profit that is exonerated from intercompany profit that is deemed to be unrealized. And you can see where the 4 million is flowing from. It's flowing from our adjustment towards determining unrealized what? Profits, which you have here. Okay, and that is that. Now, what we have simply done here is to ensure that at every point in time, our unrealized profits have to be eliminated from a transaction once it constitutes intercompany transaction. And in this case, it constituted intercompany transaction because the transaction took place about 50 days or 49 days after the date of what? Acquisition. And that is that. And remember, all other things remain what? The same. Our results will not change. Now, what we have is 68,750, and this is 750 is what we have here. Therefore, we now have to bring in our unrealized profits. Now, our unrealized profits on inventory. What's our unrealized profit? Since it's unrealized profit arising from sales by the parent to the subsidiary, will it affect the non-controlling interest? The answer is what? No. Remember, we have said it here. Since the unrealized profit is attributable to sales transaction initiated by the subsidiary, okay, this is not, is this by the subsidiary? Okay, no, this is initiated by the parents. Therefore, I need to change that expression. This is initiated by the parents. Therefore, let me go and copy where I'm supposed to have copied from. Okay, this is the one I'm supposed to have copied. I replace it with this. I want somebody to read it. What is the expression here? Who can read it? Hold on. Okay, who can read the expression?
Is it a technical note?
Yes, the technical notes. What is written there?
Sales by.
Can you see it? Let me enlarge it.
Okay, I can see it now. Since the unrealized profit is attributed to sales transaction initiated by the parent, hence the whole of the unrealized profit to be deducted for the profit of the parent, and NCI is not affected.
Therefore, NCI is not affected, which means the entire unrealized profits will be deducted from the parent, this 4 million, which is the 4 million you have here. And that is it, which means invariably, what do we have? Invariably, what we have is, to sum this up, that's 61. Which means what we have here, we now need to consider the adjustment to it, all of the adjustment here. Okay, therefore, that's our position at the end of the day. Any other question? The 64,750 is now splitted into 61 and 3.750, which is the result we produced here. Which is the result we produced here. Straightforward. Any other question as this is done, and our statement of changes in equity. It's what we have here. Any other question?
Okay, I don't know. I think we mentioned yesterday, but I forgot it. Maybe you just shed light on it. Now, especially where the old goods have been sold, I don't think we have any intercompany transaction again.
Now,
100% of it. No, 100% of the goods have
which
been
old
sold.
goods?
Whether the upstream.
If all of the goods have been sold, yeah, if all of the goods have been sold, what you will have here is very simple. This will be 50, this will be 50. Because of what? When we come here, under the unrealized profits, what percentage are we going to pay? It will be
going to
zero.
be zero. Okay, we touched it yesterday.
Yeah, we touched it yesterday. And if it is zero, what will happen?
There's no portion, there's no.
You are still going to eliminate, but there's no profit to be eliminated.
Eliminated, yes.
Okay, take note. Now, where I want you to place emphasis is this. This consolidated retained earnings, remember, we said consolidated retained earnings brought forward is the parent retained earnings brought forward plus share of the post-acquisition retained earnings brought forward by the subsidiary. But take note, the subsidiary does not exist as at last year. The subsidiary came into force just this year. And there can't be any retained profit brought forward that will be post-acquisition for the subsidiary because everything will have been pre. Have you forgotten? Therefore, in this case, there is no value there because the subsidiary was not a subsidiary as at the beginning of the year. Do you guys hear that? Therefore, I'll put zero.
Yes.
Why? Because it was not a subsidiary as at that date, as at this date. Let me just put not to shorten it. That is why this is what it is. Take note. It's not a subsidiary. Therefore, this is zero. And if this is zero, you can say now, it means there's nothing to share. Which means since it is zero, everything here is what? Zero. It can't be negative. Everything here is what? Is zero. Now, this acquisition was as at when?
1st of April, 2016.
As at 1st of what? April 20 what? 2016. Therefore, this item here that you are seeing here is the item I'm going to treat within transaction with owners of equity, which is like addition. We'll call it like introducing new capital. And this capital you are introducing the group is the value of NCI as at the date of what? Acquisition. Therefore, you call it added on what? Acquisition of Chelsea. The value of NCI. And what is the value of NCI? The value of NCI was already measured at what? 24 million, which is this 24 million we have here. Therefore, I'll come here and put 24 million. Or I can link it. Therefore, in that light, this is zero because it was not in existence. This is zero because it was not what? In existence. Let me put a note there. Always be zero or nil since the subsidiary, since Chelsea, let me use the word, since Chelsea was yet to be a subsidiary as at 1st of January 2016. Which is the same date as at 31st December 2015 or 1st of January 2016. Therefore, I'll put this expression there to always guide you at every point in time. Let me always show it. That is that. Okay. Any other question? Now, sum this up. Sum this up. Which means upon acquisition, you'll be introducing the concept of the value of NCIs at acquisition as added on acquisition to recognize the value of NCI. And at that point, you must take note that there's no subsidiary status for Chelsea as at this date. Therefore, this is 0. Okay, and that at this date, this is the value of NCI, fair value of NCI. Okay, that is that. What else? That is that as a concept. Okay, any other question? Now, we'll now replicate the same question. But in that nature, what is changing is that Arsenal is not the seller, rather Chelsea is the seller. Now let me replicate that and let's see whether our answer will change with respect to that. Let me go back to my question bank. Okay, let me use the same question. What I'll just change is to clean this up. How do I clean it up? This is Chelsea, and this is Arsenal. Now, what would have been our solution in this case? I'll call it 16B. Okay, who can assist us? What would be the solution if we have alternated? That is Chelsea that sold to Arsenal, such that what it cost Arsenal or what it cost Chelsea was 40 million.
I think that in that case, the unrealized profit will be shared between the the NCI and the parent in the ratio of ownership. That's
Okay, I want you to help me read it from here, additional information. Can you read the additional information? I can't hear you, Enaro, you are muted.
okay. It was obtained that on 19 May 2016, Chelsea already sold goods to Arsenal for 50 million when it actually cost Chelsea 40 million. As at the year end, included in the inventory of Arsenal is 40% of the inventory sold by Chelsea as at 19 May 2016.
Okay, what I'm going to do, the only issue there borders on how we are going to apportion, which is represented from this technical note I'm going to show you, how we are going to apportion the effects or the impacts of this. Now, go back to this. The revenue, which means in this case, the revenue is from the subsidiaries book. While the inventory is in the parent's book. And the cost of sales will be in the parent's book. Therefore, at the end of the day, the information remains the same. But the difference there is that this unrealized profit will no longer be attributed only to the parent, or rather, since it affects the subsidiary, all the shareholders in subsidiary will be affected in the proportion they share profit or loss, which invariably made us to have this conclusion. And what is the conclusion? Can you read it out from this technical note? Let me enlarge it. Can you read it out? You are muted, please. And now, are you there? Okay, it seems.
Let me read it.
Okay, Nudi, read it, please.
Technical notes. Since the unrealized profit is attributed to sales transaction initiated by the subsidiary, hence the unrealized profit will be deducted from the profit of the parent, percentage of the parent, which is 80%, and deducted from NCI based on percentage of the NCI, which is 20%.
Therefore, what do we do in that regard? What we do is to come back here, unlike in the first case where we only adjusted against the parent. Now, we only adjust against the percentage of the parent. It means 80% multiplied by the unrealized profits. It means 3.2 affect the parent out of the 4 million, while 20% of it which should be 800,000, will affect the NCI. And that is it. And that is it. That's our position. Which means here, what do we have? What we have is this. If you compare it with the former one, can you see 61,800 to 950? But in the former one, what do we have? We have 61 and 375. The difference is the movement of that 800,000 out of the parent, which now affected the NCI. Any other question? Any other question? Okay. That is that. Now we are going to introduce question that will recognize gain arising from a bargain purchase transaction. Remember, at the time we were preparing the group accounts, at the balance sheet level, we recognize gain on bargain purchase in an extreme situation. How do we recognize such a gain in profit or loss in the year of acquisition? That is what we want to do now. And on that premise, I'll share a question with us. Okay, let's see the question. Who volunteered to read the question?
Okay, I will read.
Over to you.
Thank you. Illustration 17. Arsenal acquired 80% interest in the equity of Chelsea as 1 April 2016. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31st, 2016. Income statement for the year ended 31st December 2016. Revenue for Arsenal 600 million. That of Chelsea is 390 million. Cost of sale for Arsenal is 345 million. Chelsea 201 million. Gross profit is 255 million for Arsenal, 189 million for Chelsea. Distribution cost is 75 million for Arsenal, 45 million for Chelsea. Administrative expenses is 105 million for Arsenal, 90 million for Chelsea. Profits on before tax is 25 million for Arsenal, 54 million for Chelsea. Income tax is 25 million for Arsenal, 29 million for Chelsea. Profit for the year, 50 million for Arsenal, 25 million for Chelsea. Movement in reserves. Retained profit brought forward, 120 million for Arsenal, 65 million for Chelsea. Profit for the year, 50 million for Arsenal, 25 million for Chelsea. Retained profit carried forward, 170 million for Arsenal, 90 million for Chelsea. Additional information required. Prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. On acquisition of the subsidiary, there was a gain on bargain purchase of 3 million naira, which is yet to be recognized.
Okay, how do you treat that transaction? How will you treat that transaction?
I think what you told us when we're doing that of state of financial position, I think that gain on bargain, gain on bargain, I think what it belongs to the parent, so it is part of additional income, probably through OCI or something, but it's additional income to the parent only.
Now, I expect us will be speaking from the position of the standard. Okay. Let's go back to what the standard says. What does the standard says with respect to all of this? Okay, contribution. Let us make it participatory.
Okay, let me say something. I remember that the time we did position of bargain purchase in the statement of financial position, the provision of the standard is that we should credit it to, we should credit the gain from bargain purchase to the retained earning.
Okay, before because you are doing balance sheet, but what does the standard say specifically with respect to gain on bargain purchase?
Okay. The standard said we should reevaluate the gain.
Okay.
I can't.
No, try. You are getting it.
The standard said we should reevaluate the gain and ensure that it is actually gain from bargain purchase before.
Okay.
I can't really understand how the standard puts it, but my understanding is that we should try and, as much as possible, to evaluate it critically to ensure that the gain is actually gain from bargain purchase before we credit it to the retained.
When you evaluate it properly,
yes,
and the gain is actually a gain from bargain purchase, what do you do?
I credit it to my retained earning.
No, that's not what the standard says. Retained earnings is like a drum that is a reservoir that you dump things into. Where is that thing coming from in the first place? Okay, let me show you something. Chapter 5 of the text. Let me share it with you. Spoke on gain on bargain purchase. And let me share the screen to refresh our memories. Okay, can we read this expression? Who volunteered to read it? Let me enlarge it a little. Can somebody read this?
Okay, accounts for gain on bargain purchase. In some business combination, but usually in an extreme case, the consideration transferred and transferable may be less than the fair value of the net assets acquired. This situation results in negative goodwill, which is often identified and recognized as a gain from a bargain purchase transaction, IFRS 3. Suggests that since arm's length business acquisition transaction will usually favor neither party, the likelihood of the acquirer obtaining a bargain is considered remote. The standard IFRS 3 revised apparent instances of bargain purchase transaction giving rise to a gain from bargain purchase are more often the result of measurement errors, which include the measurements of the fair value of the consideration transferred and those transferable, and the fair value of the identifiable net assets and liability of the subsidiary upon acquisition. Furthermore, gain from a bargain purchase can also be derived from the risk of future losses recognized by both parties and incorporated into the transaction price. IFRS 3 requires that the fair value of the consideration and the fair value of the net assets acquired are reviewed, including contingent liability that are probable at acquisition, of which the fair value can reliably be ascertained as of acquisition date, and check carefully to ensure that errors have not been made. After the review or assessment is completed, and indeed the fair value of identifiable net assets acquired net of all liabilities assumed exceeds the fair value of the total consideration transferred, then a gain from bargain purchase will be acknowledged and immediately taken into profit, i.e. recognized directly into the income statement of the group.
Okay, now I believe this emphasizes all of it. Repeat it again, please, from this point of after the review.
After the review or assessment is completed, and indeed the fair value of identifiable net assets acquired net of all liabilities assumed exceeds the fair value of total consideration transferred, then a gain from a bargain purchase will be acknowledged and immediately taken into profit, i.e. recognized directly into the income statement of the group.
Now, how do we do that? Is what I wanted to do now. Okay, which means on that premise, I want you to read the question we're about solving again, so that will make some meaning to us as we proceed. Okay, over to you.
Illustration 17. Arsenal acquires 80% interest in the equity of Chelsea on 1st April 2016. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at 31st December 2016. Okay, additional information required. Prepare the consolidated statement of profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million. On acquisition of the subsidiary, there was a gain on bargain purchase of 3 million, which is yet to be recognized.
Okay. Therefore, what do we do? Now they've determined the gain on bargain purchase for us is for us to accord it to strict accounting treatment. Okay. Now all other information remains the same, except for the fact that there is a gain on bargain purchase. Now the question is, how do we treat a gain on bargain purchase transaction? Is a question. And we have said the gain should be credited to profit or loss and solely attributed to the parent as NCI is not a party to the
Transaction.
negotiation or transaction. Therefore, in that regards, we credit the entire gain into other income of the entire income of this of the group. Therefore, we create other income. Other income. We create other income. Other income. In this case, it's gain on bargain purchase. It's going to be an adjustment from the group perspective. Is zero here, there's none here. Therefore, automatically there's none. But in our group adjustments, there is a gain on bargain purchase. And that gain was from the question here is 3 million, or figure in thousand. And invariably, when we sum it up together, we recognize a gain. Okay, all things being equal. And that's how we recognize a gain. And in our adjustment here, gain on bargain purchase. That entire gain, which is 3 million, will be reported and attributed solely to the parent. Therefore, this 3 million is coming to the parent. NCI is not a partaker. And therefore, and that is it. That is how we recognize the gain on bargain purchase. Invariably, I'll link it up with the gain, which we have here. You can see it. And at the end of the day, we have 71, which has been split into this. Okay. Now, for the first time, you are seeing how gain on bargain purchase is reported to profit or loss. Any question on that? Any question on that? Any question on that? Any question on that? Okay.
Yeah, Mr. Muiwa. Oh, 57.
Okay, sorry for the network failure. The next set of examples we are going to look at, we'll look at other comprehensive income, goodwill, and some other adjustments. But before then, I think we need to go on a short, recess.
Sorry, Mr. Muiwa, before we go on
from
short
there,
break, that gain from bargain purchase, I want to confirm.
Any other question before we go on recess?
Okay. I actually want to ask a question regarding the gain from bargain purchase. I want to know, is the gain taxable?
No, I can't hear you.
I said regarding the gain from bargain purchase that we recognize in the statement of profit or loss, is that gain taxable?
It's taxable. It's not taxable. The gain of bargain purchase is not taxable. It's an accounting gain. Okay? It's only going to create a deferred tax implication. okay, it's going to create a deferred tax implication, which is only taxable upon realization when the subsidiary is disposed of.
Okay, okay.
It's just an accounting gain. It's not a gain that will be subjected to tax.
Okay. Okay, because in our computation on Excel, you know, we recognize it before tax.
In progress.
You are mute, Mr. Moyo.
Okay, I can't hear you again. You are saying something.
I said in our Excel computation,
Yeah.
That's gain that we recognize as other comprehensive gain. We recognize it before
gain. It's other income. That gain
other income.
Income. Yeah.
I said we recognize it before profits. Before profit before tax, before taxes.
Yes.
Okay, and I think looking at our profit for the year, we've considered it as part of what we tax.
No, remember that anything you show for accounting profit has nothing to do with tax. Tax will still go back to your income, your profits before tax, subject to tax adjustments. You back it out as part of non-taxable income. Gain on bargain purchase is not taxable income. It's a group item.
Okay.
It's not item that results from normal transaction that provided a gain. It's a gain you recognize only upon business combination, that is upon consolidation, not at the point in the books of the parents. Therefore, it's not a taxable gain. It's totally exempted.
Okay, noted.
That's why you still do your tax account and assessment on the basis of the law, which means what is taken as income from accounting perspective may be recognized under tax considerations. Okay. Okay, we'll go on recess and we'll come back with other adjustments with respect to other comprehensive income and goodwill and some other things. Thank you very much. Welcome back. Let's now look at impairment loss on goodwill. Okay, I want somebody to read the question and see how we are going to address the principle with respect to treatment of impairment loss on goodwill. Over to you guys.
Okay. Resolution 19. Arsenal acquired 80% interest in the equity of Chelsea as of January 1st, 2020, when the retained earnings stood at 20 million. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statement of the subsidiary with that of the parent as at December 31, 2016. The cost statement is given below. The required information. Prepare the consolidated profit and loss statement of changes in equity of Arsenal stood at 200 million and that of Chelsea amounted to 200 million. And the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million. As at the reporting date, 31st December 2016, the goodwill has been impaired to the tune of 12 million, and of which only 5 million represent the impairment loss attributable to 2016 financial year.
Okay, thank you very much. Now let's try and solve the question. Now the major item here is of the fact that goodwill has been impaired to the tune of 12 million. But of the 12 million, 5 million relates to 2016, which means the difference, which is 7 million, relate to prior years before 2016. Now, remember that we are dealing with profit or loss for the period ended, or for the year ended 31st December 2016. What that presupposes is that we are only interested in the current year impairment, not in the total impairment over time, because that of over time will have been treated in prior years. We only need that when we are to determine our opening retained earnings. But for our profit or loss item, what we are interested in is the current year. And that's what it means. This 5 million relates to 2016. Now, on that premise, what do we do? Remember, acquisition took place 2010. That was about 6 years ago, or 7, as the case may be. Okay, this is not acquisition during the year. Therefore, we must take notes. Therefore, let's bring out the transaction. If the information remains the same, I think it remains the same. Okay, there is no intercompany transaction. The only transaction we have here is the treatment of goodwill. Therefore, I come here, treatment of impairment loss on goodwill. Now, the first thing is the cumulative amount of goodwill, impairment on goodwill, should be analyzed. It's broken down as follows. We need to break it down. Now we break it down into current year, that is 2016 financial year, current, and previous years up to 31st December 2015. Now, the sum of it is what totaled 12 million. Now, 5 million, according to information, is for the current year. Balancing figure between this 12 and 5 is the 7 million that relates to previous years. I'll put that as my balancing figure. Okay, now treatments of current year, that is 2016 financial year, impairments. Loss on goodwill. How do you treat that? That will be charged to the subsidiaries, profit or loss, and of which the impact will be a deduction of 80% of the impairment loss to the parent's profits or loss, and 20% to NCI. Who can tell me why we are allocating or attributing or deducting it against both the parent and NCI? Who can remember before I put it in my own words? Okay. Since the goodwill is a full goodwill. Remember, what is a full goodwill? What is a full goodwill? I can't hear you.
Full goodwill is the goodwill that consider both parents and NCI.
Okay, is a goodwill where both the parent and NCI contributed to by way of recognition. And this is attributable to the fact that NCI is measured at fair value.
Exactly.
And how do I know that the NCI is measured at fair value? Who can tell me in this question? If you check here, NCI is measured at fair what? Value of 24 million. Can you remember? Yeah?
Yes.
This expression is what gave it us. It gave us the understanding of that principle. Therefore, I'll come here to debit subsidiaries profit or loss. I will credit the goodwill. Remember, it's a full goodwill. That's why the impact of it will affect both the parents and the NCI. Therefore, what is the loss? 5 million. Remember, that is that. Now, let's take note of that. Okay, which means if you come here quickly, goodwill is reported within administrative expenses. That's impairment loss on goodwill. Therefore, this is charged to subsidiary profit or loss. That is, let me put it there, administrative expenses. Okay, take note of that. Okay, I come to administrative expenses. I recognize that amount as an addition to the expense. How much is it? The 5 million. All figures in thousands. What he has done is that he has increased my admin expenses, but reduced my profits by 5 million. Which then means that my adjustment here is to reduce the distribution or profit attribution by impairment loss on full goodwill, which invariably you share 80-20. %80 of that loss I put it in negative because it's a loss, and I copy the formula and change it to 20% for the NCI, because that's the proportion the share profits or loss. In that case, I'm able to produce these results. Okay, let me sum it up. This 66, and the second one is 4 million. Okay, when you come back here, you find that we've allocated the 70 million into 66 and 4 million, and that is that. Now, the most important aspect now is to deal with the statement of comprehensive income, which is our opening consolidated retained earnings and NCI. Remember that this 7 million was for prior years up to 31st December 2015, which will have eaten into the retained earnings of the subsidiary, which will have affected the parent and the NCI, which means the 7 million also in the ratio 80-20 will be deducted against the share of post-acquisition profit, which means in this case here, we are going to deduct the goodwill, the portion that relates to prior year, which means in this case, minus impairment loss on goodwill prior years. Okay, let me shift it down so I can enlarge the cost. Okay. I'll do the same thing here. I'll deduct it. And what is the prior year? Prior year impairment loss from this scenario is the 7 million. Therefore, how do we treat that? I'll come here also. Treatment of prior year. Up to 31st December 2015. We charge against the subsidiaries post acquisition retained earnings. And what that implies is that the impact will be 80% deduction in the parent's share of the post acquisition retained earnings prior to the impairment loss, and 20% in the same light for the non-controlling interest. Therefore, in that light, let me move this downwards. What that simply means is this portion the post-acquisition retained earnings as at 31st December 2015, which is the opening in 2016. Okay, and this will have affected goodwill. How much is that? 7 million. Now, how do we do that? The effect of that will be on our retained earnings here, which says that apart from deducting pre-acquisition retained earnings, which was the 20 million, from our 65 million, which is subsidiary retained earnings brought forward, we also have to deduct the 7 million from it. And the 7 million is the prior year depreciation. Therefore, I deduct the 7 million. That gives me 3,400. I deduct the 7 million, which means what we are sharing net is after pre-acquisition reserve and after prior year impairment losses. And all of this will affect our consolidated retained earnings brought forward and our value of NCI brought forward. Any question on that? Which means what we have brought in that is new, let me put it in another color so I can more or less show emphasis. Is this. Any question? Any question on that? Okay, if there's no question, the impairment loss on goodwill is treated as part of administrative expenses, and the treatment, whether to attribute it to parent and NCI, is a function of, is it a full goodwill or a partial goodwill? in this question is a full goodwill. Now we are going to look at question 20, where it is a partial goodwill. And let us see what happens in that light. Any question? Any question? Okay, if there's no question, let me replicate this. I'll copy question 20 and paste it here. Okay, I can delete this. Now this is question 20. Now I want somebody to read 20 and tell me the significance between 20 and question 19. And what will you do if you find yourself in that situation? Over to you guys.
Okay, let me read question 20. Illustration 20. Arsenal acquired 80% interest in the equity share of Chelsea on January 1st, 2010, when the retained earnings stood at 20 million. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at 31st December 2016. Okay, required. Prepare the consolidated statement of profit or loss and this consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 130 million, and the amount of non-controlling interest at acquisition was measured at the proportionate share of the subsidiary identifiable net assets, which amounted to 30 million. As at the reporting date, 31st December 2016, the goodwill has been impaired to the tune of 12 million, and of which only 5 million represent the impairment loss attributable to 2016 financial year.
Okay, what is the treatment you accord this from your own perspective?
Okay, from my own perspective, this is an impairment loss, and for the fact that the NCI was measured using proportionate share of the subsidiary identifiable net assets, it gives me an impression that this is a partial. It is a partial goodwill that resulted to that impairment. Meanwhile, the burden of the impairments will be borne by only the parents, because it is a partial goodwill.
What makes it a partial goodwill, and why must it only be the parent that bears that brunt? Okay.
From the question, there are indications that, number one, the NCI was not measured using fair value, and number two is that if they actually use fair value method, it will give rise to full goodwill. But in as much as the goodwill was determined using in as much as NCI was measured using proportionate share of identifiable net assets of the subsidiary, it implies that the goodwill is a partial goodwill. Therefore,
this goodwill
the goodwill
is a partial
only
goodwill.
yes.
Okay.
It means
partial goodwill only
the
recognize the
contribution of that
the
goodwill
parent
is only by the parents,
or the parent.
not inclusion of
Based on the
subsidiary.
accounting policy.
Yes.
Based on the accounting policy of the group. Okay. Thank you. Now, the only difference in the question here is very simple. It is the treatment of the goodwill here we have to change. We'll start from the treatment of the current year goodwill. Here, you charge to subsidiaries profit, and of which the impact will be deducted only. Only means 100% of the impairment loss to the parent profit or loss. NCI in this case is not affected. Since what? Since the goodwill is a partial goodwill. Now, since it's a partial goodwill, the whole 100% goes to NCI, goes to the parents. Therefore, which means in this case, what do? Instead of 80%, it will be 100%. And that is this and this. Therefore, all of this and that is it. Which means everything affects the parent only. Now, who can tell me what will happen to the consolidated? What will happen to the consolidated statement of changes in equity?
Okay, for the consolidated statement of change in equities, the 7 million portion of impairment, which was as a result of period before 1st of January 2016, will be deducted from the subsidiary retained earning brought forward.
Okay, let's see what happens here. Now, similar thing we did for the current year, we replicate it for the prior year, which means the charge is to the post-acquisition profit, yes, and the impact will be a deduction of 100%. Okay, and the same expression we use here that we are going to use here. But what is the difference is that it's going to be the parent share of the, to be 100%. That is only of the impairment to the parent's share of the post impairment loss, yeah. To the parent share of the post-acquisition retained earnings prior to the impairment. Okay, NCI is not affected. Hence, NCI is not affected. Therefore, in that light, what do? We come to this section. NCI will not be affected. Therefore, we take out the portion that will have affected NCI. Which then means that here, in this case, it will be the entire amount is what we are going to deduct, okay, against the parents. And instead of you deducting it before the percentage, you deduct it after the percentage so that the whole item affected, and NCI in this case is not affected. Which means what we are simply done is that this is 80% of this. What you get after that is when you now deduct your impairment loss, because 100% of the impairment loss goes to the parent. Okay, which means if you check my symbols, this will have been computed as a single item. The value you get is what you now deduct the impairment loss from to arrive at 29. Why here, we are not deducting anything against the subsidiary, against the non-controlling interest, because it's a partial goodwill. Okay, any question? Any question here? Yeah, your credit is to partial goodwill, not full goodwill. And we already know what a partial goodwill is. Any question here? Any question? Which means the treatment is just to take note that goodwill, impairment loss on goodwill only affects the parents and the NCI if it's a full goodwill. Otherwise, it only affects the parent if it's a partial goodwill. A partial goodwill is a goodwill in which the parent's goodwill contribution is the only portion of goodwill recognized. While a full goodwill is where both the parent portion and the NCI portion are collectively recognized from the group perspective. Any other question? Any other question?
No questions.
Okay. Now let's now look for the first time illustration that has other comprehensive income. Remember, all what you have been doing since is on profit or loss. Now, what if you have other comprehensive income? What will have been the impact? Let us look at this question. This question should give us some clue about that. Okay, who will read for us? Illustration 18. We can't hear you, Nuruddin.
Let me see. Illustration 18. I thought you've done illustration 18 before.
No? Have you done comprehensive income?
No,
Not done illustration 18.
I thought you were in, okay, I thought you were in illustration 20 or something.
Yeah, that doesn't mean we have done 18.
Oh, okay. Okay, I take the question. Illustration 18, under comprehensive income. Arsenal acquired 80% interest in the equity of Chelsea as of January 1st, 2014, when it was incorporated. The board of Arsenal strictly wants to comply with the requirement of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as of December 31st, 2016. The income statements are given, then required. Prepare the consolidated profit or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million and that of Chelsea amounted to 100 million, and the amount of non-controlling interest at acquisition as measured at a proportionate of net asset shares stood at 20 million. Okay. So there is a portion of other comprehensive income that says fair value gain and loss on financial assets measured at fair value through other comprehensive income was 10,000 for Arsenal, a loss, and 3,000 for Chelsea, which is a gain. So that is the portion that relates to other comprehensive income. Okay, there is also a revaluation surplus on property and plant. Revaluation surplus on property, plant, and equipment. 4 million gain for Arsenal and 2 million gain for Chelsea. Okay. Those are two major items on other comprehensive income. Question.
Now, if you check it, the whole of this question, this with aspects. Let me try and highlight it. This with the aspect of other comprehensive income. This is the aspect we want to introduce. When we have other comprehensive income, how are we going to treat it? We treat it in the same vein with the way we have treated income statements. Therefore, how do we do that? Let's go back to our schedule. We have to expand our consolidation schedule. We have to expand our consolidation schedule. How do we expand our consolidation schedule? Okay, let me expand it downwards. Okay, I think this is enough. Okay, I'll take this downward. And what do? We now have the section for other comprehensive income. Now, under that section, what are the items we have? We have the item considered to be fair value gains or loss on financial assets measured at fair value through OCI. And the other one is valuation surplus on property, plants, and equipment. Okay. Now, the same thing we have here, I'll just try and extend it. Yeah. Now, what are the items we have? We have loss of 10 million for the parents, whereas gain of 3 million for the subsidiary. Here we have gain of 4 million for the parent. Here we have loss of what? A gain of 2 million. That is that. Now I can sum this up and it gives me 6 and that. Okay. Now, this is my other comprehensive income. Now, to get my total comprehensive income, let me take this down one more. My total comprehensive income is the sum of my profit for the year and my other comprehensive income. Okay. 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 Okay, that's it. Now, there's no adjustment we are doing here other than extending our consolidation by way of aggregation of line-by-line item with items of other comprehensive income, starting from fair value gain on financial assets measured at fair value to other comprehensive income. We sum it up together, we have negative 7 million. Our revaluation surplus, we add it together, we have positive of 6 million. And that is that. Now, what do we do? Is for us to also attribute our other comprehensive income. How do we attribute our other comprehensive income? Is for us to say our total comprehensive income attributable to the same thing we have, the parents, and the NCI. Therefore, the first thing is to bring what we have as profit attributable, which is already obtained at 70 and 75, which means the output of that is an input to this. Because total comprehensive income is made up of profit for the year and other comprehensive income. Now come here, other comprehensive income. What are the two elements in that? We have this and we have this. Now, let us pick it one by one. We have this. Okay, I think I still have to extend this a little more downwards. The 2 cells downward, yeah, that should be okay. Now, I have this portion, the one that is for parents and the one that is for subsidiary. The one for subsidiary will be shared in ratio 80-20. because both the parent and NCI have stake in the subsidiary. Why do you want for parents? When it goes to the parents, you take note of that. I then need to extend this furthermore. I think 2 notches. I think it's okay now. Okay, now doing this, these are the new items we are bringing in. Let me give this separate color. Let me give this green color. Okay, now the parent own has nothing to do with NCI. Parents' fair value loss on financial assets will go directly to the parents only. While the subsidiary own gain, which you can see here, this 3 million, will be given to both the parents. The parents will take 80% of that 3 million. And NCI will take 20%. It's the sum of these two that gives me 3 million, which is this amount here. Okay, similarly, the revaluation gain of the parents will go to the parent alone, while that of the subsidiary will be shared between the parents in ratio 8 of these two to 20, which is of the NCI. Now, all in all, we sum up all of this to arrive at the attribution of this. And 68 and 6 is what make up 74. And 70 and 5 is what make up 75. And that's what we are saying here. Okay, which means the parents had a reduced amount of total comprehensive income attribution compared to profits attribution because he on his own experienced massive loss from his financial instruments, which is what you can see here. Therefore, what do? We extend that to here. Thereby, I'll bring this down in order to recognize my other comprehensive income. My other comprehensive income, I have 2 elements there, this and this. And what do I have? What I have is 7 and 6. And this 7 and 6 is what I'll sum together. I can even sum it together on this angle. Let me bring it to this angle. Okay, so that once I sum it together, yeah, I report it at the extreme end there. Therefore, the sum of this and this is what gives me my total comprehensive income. Therefore, what is my total comprehensive income? My total comprehensive income is the sum of this. And that's it. Now, this is the first attribution The second attribution will be to attribute my total comprehensive income into portion of owners and this. And I already have it here. I just pick it up from here. 68 and 6. And that's how I have it as a whole. I copy, I paste, and this is it. Does it make sense now? Does it make sense?
Yes. Yes.
And that is it.
Yes.
Look at it again. The same way you done for income statement is what you do for other comprehensive income. And the same way we attribute profit is the same way you do total comprehensive income. Only that first, the result here, which is 70 and 5, will flow in here before you now consider other items of other comprehensive income. Okay, but remember, all of these components here will be reported through other component of equity, which then means that when I now come here, that's why I created a column. I'll now bring a column here. Let me shift this one notch. I'll now come here with another notch. Some. Okay, now this will now be other component of equity. I'll call it other components of equity. Okay, should I use it? I can call it OCE, other component of equity. Okay, in that, there's no opening item for it because we don't have it as our opening balance. It's not there as our opening balance. Okay, I think we have. If you go back to the question, that is other reserve, other component of equity we have. Therefore, we're going to apply the same principle. Therefore, we need to get the balance, opening balance. I'll put a color. What color should I put? Let me put green. Okay. But other component of equity we are doing the year, I'll put that. What's the other component of equity we have? We have two items. One is fair value. The other one is revaluation. Okay. Now, we can bring those components here. For fair value gain or loss, the one that affect the parents is these two items for financial assets. That is the 10 million negative and 2.4 million from subsidiary. And here, for the valuation gain, 4 million for parents and 1.6 million from the subsidiary. Whereas for NCI, NCI only takes the portion of the subsidiary 600 for fair value gain and 400 for evaluation surplus on people. That is that. Okay. I extend this summation. Okay. Now, the only thing we are looking for is other component of equity. The same way we have done this reserve, the same way we do others. Okay. Let me shift this upward. Therefore, what do? We use the same knowledge, yeah? Now I'll come here. The same knowledge I used here is what I'll use here. I'll call it working note 3. Consolidated other component of equity. This accommodates all other reserves other than retain what? Earnings. Therefore, I'll substitute where I have retained earnings for that. The same treatment is what I'll do. Exactly the same treatment. Nothing is changing because it's also a component of reserve. Therefore, here, I'm going to deduct pre-acquisition other component of equity. That's OCE. Because other component of equity is otherwise known as OCE. Take note of it. Okay, now for NCI, I'll also do the same thing by taking this and I'll bring it here by substituting share for NCI because NCI is 20%. That's it. Now, what is the item? We come here, parent other component of equity brought forward. Okay, parents other component of equity brought forward. Let us create that schedule here. And I needed pre-acquisition. The same way I have it here. Parents, that's subsidiary pre-acquisition, other component of equity. subsidiaries, other component of equity brought forward, and parent, other component of equity brought forward. And I picked them from my information here. You have it here. Parents brought forward is 38, subsidiary is 4. Therefore, I'll come here, 38 is the parent, subsidiary is 4. And pre-acquisition. As an acquisition, we're told that we acquired when it was incorporated, which means our pre-acquisition is 0 for retained earnings and also is 0 for other component of equity, because this was as an incorporation. But if you have a balance, you put those balances there. Therefore, what do we do? Okay, what do we do in this case? We come down here, the parent own is 38, we take note of it. Parent share in the post-acquisition will be the product, which is 80%, of the difference between the brought forward for the subsidiary, 4 million, and the pre-acquisition, which is 0. And that gives me 3.2. The same formula is what I'll copy for the subsidiary and for the NCI, only that I'll change NCI from 80% to 20%. And that is it. But instead of me typing 80%, I can go ahead and link this 80% so that I can make it a template anytime I need to change it. And yeah, instead of typing 20%, I link it up with the percentage of 20%. And that is it. And at the end of the day, I'm able to pick the other component of equity as consolidated for the parent, which is 41.2 million. I'll change the color. Okay. NCI, what color do I use for NCI? I have to change this to the color for NCI. Okay, and that is that. Any question? Any question? I remember our acquisition was 20 million. Therefore, I'll change this to 20 million. It's measured at what proportionate share, which is 20 million, not 24. Any other question? Any other question, please? Now, what is the new thing that we brought in? Who can explain those new things we brought in?
Okay, the new thing we introduced here is the effect of other comprehensive income in relation to consolidated statement of financial statement of profit or loss and the consolidated change in equity. However, the changes we have here are fair value gains or loss on financial assets, which was measured using fair value through other comprehensive income, and the revaluation surplus on property, plant, and equipment. However, the treatment was carried out on consolidated statement of profit or loss by creating additional column which recognized the other comprehensive income in the statement of profits or loss and other comprehensive income. We recognize the portion of parents and subsidiary accordingly, while we replicate same in our consolidated statements. Okay, but the treatments we have for fair value gain or on financial assets is that for fair value gain on financial assets, the one as attributable to parents was carried out for parents only, while the one that belongs to subsidiary was apportioned between the parents and NCI, because parents has a stake in subsidiary, and the proportion was carried out based on the proportion, the stake of parents in the subsidiary and the portion of NCI accordingly. That was how it was treated, and for both fair value gains and the revaluation surplus on property, plants, and equipment. Okay, then additional treatments we had is to check if there was a fair value, if there was a fair value opening balance. Let me put it down. If there was opening balances for fair value gain and revaluation surplus, which we are to carry out the apportionment accordingly for both parents and NCI. For the parents, we carry out the value. We brought forward the entire value for the parents, while for NCF, for the subsidiary, we apportion it based on the stake of the parents in subsidiary and the portion of NCI. That was how we carried out that adjustment for both fair value and the revaluation surplus, and that is how we reflected our balances in the statement of changes in equity. I mean, consolidated statement of changes in equity accordingly. Thank you.
Okay, thank you very much. Thank you very much. And that is what we've done. And that has shown us a good understanding of what it is at that point in time. Okay, any other question, if any, so that we can move ahead?
So for the NCI, the NCI, both the return for the NCI.
Yeah. All of the reserves, NCI only have one account. That's why everything that belongs to NCI go into that single bucket.
Okay.
Yeah. Is that okay? Okay, in the absence of none, we'll end it. And part 3 is where we'll discuss other issues. Other issues in part 3 will be when we have contingent consideration, deferred consideration, and it has discount embedded in it, how do we unwind the discount? And how does the discount impact our consolidated statement of profit or loss and our changes in equity? We are going to look at that. We'll look at some other aspects, which also borders on various aspects in unwinding of discounts. We may more or less look at aspects that this with preference shares, where dividend is paid, if any. But those are the little ones we are going to look at. And in addition to that, we'll now go into accounting for investment in associates and joint venture. At that point, we'll be able to wrap up all of those aspects there before we move to other aspects in group accounts, such as consolidated statement of cash flows, such as changes in interest in group piecemeal acquisition, and probably disposal within a subsidiary, and some other things like that. Any other question? Any other question? In the absence of any question, we'll call it a day. Thank you very much, and God bless you guys.
Okay, God bless you too, sir.
Thank you very much, Mr. Muiwa.